Looking at the charts day after day, watching prices jump up and down like a roller coaster, most traders feel completely lost in the chaos. They chase every signal, jump into every breakout, and wonder why their account keeps shrinking instead of growing. But here's what nobody tells you when you first start trading. The market doesn't reward complexity. It rewards patience, discipline, and understanding what actually moves prices. The traders making consistent money aren't using secret indicators or magic formulas. They're reading the same charts as everyone else, just through a completely different lens. They see volume where others see nothing. They recognize price behavior where others see randomness, and most importantly, they think in months and years, while everyone else is panicking about minutes and hours. Let me share something that changed everything about how I approach the markets. After years of jumping between strategies, indicator overload, and disappointing results, I realized the problem wasn't finding the right strategy. It was understanding what makes any strategy actually work over time. The answer lies in three fundamental approaches that professional traders have used for decades. Approaches that work whether you're trading stocks, forex, commodities, or anything else with a price chart. The foundation of successful long-term trading starts with understanding that markets move in cycles, not straight lines. Every asset goes through periods of accumulation where smart money quietly builds positions, markup phases where prices rise and everyone notices, distribution where the smart money exits to late buyers, and markdown where prices fall back down. Recognizing these cycles requires you to step back from the minute-by-minute noise and look at weekly and monthly charts. When you trade with these larger cycles instead of fighting against them, your entire perspective shifts from trying to catch quick moves to positioning yourself for substantial trends that can last months or even years. The most powerful long-term trading strategy revolves around identifying assets in strong uptrends and simply staying with them until the trend clearly breaks. This sounds almost too simple, but simplicity is exactly what works. You're looking for markets that are making higher highs and higher lows on weekly charts, where the price stays above major moving averages, and where each pullback gets bought aggressively. The key is patience during those pullbacks. When everyone else panics during a normal correction within an uptrend, you're either holding your position confidently or looking to add more. This requires developing the mental strength to ignore short-term volatility and trust the larger structure of the market. Position sizing becomes critical in long-term trading because you need to survive the inevitable drawdowns that come with any position held for months. Professional traders typically risk only 1 to 2% of their capital on any single trade, which feels frustratingly small when you're eager to make money quickly. But this conservative approach means that even a string of losses won't devastate your account. When you combine small position sizes with trades that aim for large moves, the mathematics work heavily in your favor. You can be wrong half the time and still make substantial profits because your winners are much larger than your losers. Entry timing for long-term positions focuses on buying during weakness within strength, not during moments of maximum excitement. When a stock in a clear uptrend pulls back to a major support level, perhaps a moving average or a previous resistance turned support, you're getting a better price than the people chasing it at new highs. This requires going against your natural instincts because buying during a pullback feels uncomfortable. It feels like you're catching a falling knife. But the best entries almost always feel wrong in the moment. You're buying when others are worried, and you're planning to sell when others are euphoric. Stop-loss placement for longer-term trades needs breathing room. Tight stops that work for day trading will get you shaken out of perfectly good long-term positions. Instead, you place stops below significant structural levels, areas where if price reaches them, the entire thesis for the trade has changed. This might mean giving a trade 5, 10, or even 15% of downside room, which again requires proper position sizing to keep your actual risk manageable. The benefit of wider stops is that you avoid getting stopped out by normal market noise and give your trades room to develop properly. Now let's talk about volume profile, one of the most misunderstood yet powerful tools available to traders. While most people stare at candlesticks trying to predict the next move, Volume profile shows you where the actual trading activity happened, where buyers and sellers agreed on value. This information is incredibly valuable because markets tend to return to areas of high volume. These are the fair value areas where lots of trading occurred. Conversely, areas of low volume get passed through quickly because there's no consensus on value at those prices. Understanding volume profile starts with recognizing the difference between price and value. Price is simply where the last trade occurred. It bounces around constantly based on moment-to-moment supply and demand. Value is where the majority of trading volume took place, where market participants agreed to do the most business. When you pull up a volume profile on your chart, you'll see a histogram showing the distribution of volume at different price levels. The point of control, the price level with the most volume, acts like a magnet. Prices tend to gravitate back toward these high-volume areas when they move away from them. The practical application of volume profile in your trading is identifying areas of support and resistance that actually matter. Traditional support and resistance, based purely on where prices touched in the past, can be misleading. Volume profile shows you where substantial trading occurred, which creates much more significant levels. When price approaches a high-volume node from above, you can anticipate support because lots of previous buyers will defend their positions there. When approaching from below, that high-volume area may act as resistance because previous buyers who are now underwater will look to exit break-even. Volume profile also reveals poor high areas, price ranges where very little volume traded. These low-volume zones happen when prices moved quickly through a level, creating what traders call acceptance gaps or value gaps. When price returns to these areas, it tends to move through them quickly again because there's no value consensus there. You can use these zones to set price targets, knowing that once price enters a low-volume area, it will likely travel to the other side, quickly looking for the next high-volume area where trading can occur efficiently. One of my favorite volume profile strategies involves waiting for price to break out of a high-volume consolidation zone. When a market spends weeks building volume at a certain price range, it's establishing a new value area. Eventually, buyers or sellers will win the battle and push price out of this zone. Once the breakout occurs, that previous high-volume area now acts as strong support on pullbacks if the breakout was upward, or resistance on rallies if it broke downward. The best part is these setups work across all timeframes. You can find them on daily charts for swing trades or even hourly charts for shorter-term positions. Combining volume profile with market structure gives you a complete picture of what's actually happening. You're not just seeing where price went, you're seeing where participants agreed to do business and where they didn't. This helps you avoid getting caught in traps that fool traders who only watch price. For example, price might make a higher high, which looks bullish on a regular chart. But if volume profile shows that high was made on very low volume with price quickly rejecting back down, you know that new high wasn't accepted as value. Smart traders don't chase that breakout. They wait for price to return to the high volume value area and look for directional clues there. Simple price action trading strips away all the indicators, oscillators, and complex systems to focus purely on how price behaves at key levels. This approach recognizes that price contains all available information. Every news event, every earnings report, every economic data release, every trader's opinion, everything gets distilled into one simple output. Did price go up or down? And how did it move when it got there? Learning to read price action is like learning a new language. At first it seems like meaningless squiggles, but once you understand it, you can see the story of battle between buyers and sellers playing out in real time. The foundation of price action trading is identifying market structure, the sequence of highs and lows that define whether a market is trending or ranging. In an uptrend, you get higher highs and higher lows, each peak and trough higher than the last. In a downtrend, lower highs and lower lows. In a range, price bounces between a ceiling and floor without making progress in either direction. This sounds elementary, but most traders fail to correctly identify what structure they're in, leading them to use trending strategies in ranges or ranging strategies in trends. Both recipes for losses. Once you've identified the structure, price action trading focuses on how price behaves at key levels within that structure. In an uptrend, you're watching what happens when price pulls back to support levels. Does it bounce strongly on high volume, showing demand? Does it hesitate and form small indecision candles before bouncing, showing buyers need time to overwhelm sellers? Or does it slice through support like butter, suggesting the trend might be over? These behavioral clues tell you whether to take the trade, wait for more confirmation, or avoid it entirely. Candlestick patterns form the vocabulary of price action, but not in the way most beginners use them. Forget about memorizing dozens of exotic patterns with fancy names. Focus on a handful of reliable formations that show genuine shifts in supply and demand. A pin bar or hammer at support in an uptrend shows rejection of lower prices. Buyers stepped in forcefully and pushed price back up, leaving a long tail. An engulfing candle, where one candle's body completely covers the previous candle, shows a strong shift in momentum. One side completely overwhelmed the other. These patterns mean something because they represent actual battle outcomes between buyers and sellers, not because some book said they're bullish or bearish. Context makes all the difference with price action patterns. A pin bar in the middle of nowhere on a chart means nothing. That same pin bar rejecting off a major support level where previous buyers have money at risk, that means something. A break of structure where price takes out a significant high or low means something because it invalidates the previous pattern and forces trapped traders to react. Price action traders are constantly asking, where am I in the larger structure? And what does this price behavior mean at this specific location? Support and resistance in price action trading comes from obvious levels where price previously reversed or consolidated. You're looking for areas that even a child could identify on a chart, big round numbers, previous major highs and lows, areas where price spent substantial time consolidating. These levels work not because of mystical properties, but because thousands of other traders can see them too. Previous buyers have stops below support levels. Previous sellers have stops above resistance levels. New traders are waiting at these levels to enter. And all this combined activity creates self-fulfilling prophecies that make these levels significant. The beauty of price action trading is it works on any market and any time frame because you're trading human behavior, not indicators that might work in some conditions but fail in others. Whether you're looking at a 5-minute chart or a monthly chart, you're seeing the same patterns of trending, ranging, breaking out, and pulling back. The psychological forces driving these patterns remain constant because human nature doesn't change. Greed, fear, hope, regret. These emotions drove traders 100 years ago and they drive traders today, leaving the same footprints in price action. Trading false breakouts is one of the most profitable price action strategies once you learn to spot them. Markets love to trap traders by briefly breaking important levels before reversing sharply. This happens because breakouts attract momentum traders and stop out traders positioned on the wrong side, creating a surge of orders. Once these orders are filled and there's no follow-through, price snaps back, trapping everyone who chased the breakout. You can profit from this by waiting for breakouts to fail, entering when price moves back inside the previous range, targeting a move to the opposite side of the range. Learning to read the strength or weakness of a move is crucial in price action trading. Strong moves happen on long candles with small wicks, showing one side dominated. Price barely pauses as it moves through levels. Weak moves have lots of overlapping candles, long wicks showing rejection, and price grinds slowly rather than surging. When you see strong price action in the direction of the larger trend, that's confirmation to trade with that trend. When you see weak price action attempting to move against the trend, that's confirmation the trend will likely continue. Putting these three approaches together creates a robust framework for consistent trading. Your long-term strategic view tells you which markets are in the right overall structure to trade. Your volume profile analysis shows you the specific levels where you'll look for entries and where you'll expect support or resistance. Your price action reading tells you when to pull the trigger and when to wait. No single approach works perfectly alone, but combined they cover each other's weaknesses and give you multiple filters to avoid low-probability trades. The mental side of executing these strategies consistently is where most traders fail. You can know everything I've just explained and still lose money if you can't control your emotions. Patience is the hardest skill to develop because markets don't move on your schedule. You might wait days or weeks for the right setup, and then the trade might take weeks or months to play out. During that time, you'll doubt yourself. You'll be tempted to take profits too early. You'll want to move your stop loss when price comes close to it. You'll see other opportunities and want to abandon your plan. Successful traders develop the discipline to trade only their planned setups and manage them according to their rules, regardless of emotions. Risk management separates professionals from gamblers. Every trade you take should have a predefined risk, a specific amount you're willing to lose if you're wrong. This amount should be small enough that even several losses in a row won't significantly damage your capital or your psychology. Your position size should be calculated to keep your risk consistent across all trades. A tighter stop allows a larger position size. A wider stop requires a smaller position size, but the dollar risk remains constant. This approach means you're never betting the farm on any single trade, which allows you to think clearly and execute objectively. Keeping a trading journal transforms your development from random trial and error into systematic improvement. Record every trade with screenshots showing your entry, your reasoning, where your stop and target were placed, and then the outcome. Review this journal regularly, looking for patterns in your winners and losers. You might discover you're great at identifying setups, but terrible at managing profitable trades. Or maybe your entries are random, but your trade management is excellent. These insights show you exactly where to focus your improvement efforts rather than trying to fix everything at once. The markets will humble you repeatedly regardless of which strategies you use. You'll have drawdowns, losing streaks, and trades that seemed perfect but failed anyway. This is normal and unavoidable. What separates traders who eventually succeed from those who quit is how they respond to these inevitable difficulties. Successful traders view losses as the cost of doing business. They review what happened, extract any lessons, and move on without emotional damage. They don't revenge trade. They don't abandon their strategy after a few losses, and they don't risk more to try to get back to break-even quickly. Understanding that trading is a game of probabilities rather than certainties changes your entire approach. No strategy wins every time. A strategy that wins 55% of the time with good risk-reward ratios will make you wealthy over hundreds of trades, but it will also lose 45% of the time. Your job isn't to find the perfect strategy that never loses. Such a thing doesn't exist. Your job is to find an approach that gives you a genuine edge, execute it consistently enough for that edge to play out, and manage risk so that the inevitable losing periods don't destroy your account. The journey from struggling trader to consistently profitable takes most people several years of focused effort. There's no shortcut around the learning curve, the screen time required to recognize patterns, and the emotional development needed to execute properly under pressure. But here's the encouraging part. It's absolutely achievable if you commit to the process. Thousands of traders have walked this path successfully before you, learning these same concepts, making similar mistakes, and eventually figuring out what works. The strategies I've shared aren't secret or complicated. They're straightforward approaches based on how markets actually function. Your success depends not on finding better strategies, but on mastering these fundamentals and applying them with discipline and patience over time.